Brad Williams, Frugal Finance, cost of capital. Equity is clearly a vital and essential ingredient of the financing mix for every business, but nearly all public businesses finance some or a good deal of their operations with debt or some mix of equity and debt. The cost of using these financing sources are generally quite different from the cost of equity. Therefore, the minimal acceptable hurdle rate for a project will reflect their costs as well in proportion to their use in the financing mix. Intuitively, the cost of capital is the weighted average of the cost of the different mix of financing, including debt, equity, and hybrid securities used by companies to fund their day-to-day operations. The cost of capital, the default risk, the risk that a company might not be able to make its required debt payments, such as interest expenses or principal payments. To estimate the cost of the funding that a company wants, we have to estimate the cost of all of the non-equity pieces. In this section, we look at the cost of debt and then move our analysis to hybrids, including preferred stock and convertible bonds. The cost of debt measures the current cost to the company if they borrow money to fund projects. In general terms, it is determined by the following variables: the current level of interest rates. As market interest rates rise, the cost of debt for all companies will also rise. The default risk of the company, as the default risk of a company increases, lenders will charge higher interest rates, a default spread, to compensate for the added risk. The tax advantages tied to debt, since interest is tax deductible, the after-tax cost of debt is a function of the tax rate. The tax benefit that accrues from paying interest makes the after-tax cost of debt lower than the pre-tax cost. Also, this benefit raises as the tax rate increases. After-tax cost of debt equals risk-free rate plus default spread times 1 minus the marginal, not the effective, the marginal tax rate. The challenge in estimating the cost of debt is really one of estimating the correct default spread for a company. Default risk and default spread of a company. The easiest way to estimate the cost of debt is if a company has long-term bonds outstanding that are widely traded and have no special features, such as convertibility or first claim on assets, skewing interest rates. The market price of the bond, together with its coupon and maturity, can serve to calculate a yield we use as the cost of debt. For example, the approach works for companies that have a large number of outstanding bonds that are liquid and trade frequently. Many firms have outstanding bonds that rarely trade on a regular basis. Given these firms are usually rated, we can determine their cost of debt by using their rating and an assigned default spread. Thus, Granite Construction with a B rating can be expected to have a cost of debt approximately 3.28% higher than the Treasury bond rate in July of 2021, because this was the spread typically paid by B-rated firms at the time. Some businesses are just not rated at all. The majority of private companies and many smaller ones fit into this group. In many emerging markets, rating agencies have increased. However, in many other markets, companies are not rated due to their default risk. When estimating the cost of debt without a rating, one of two things can be done. Recent borrowing history. Countless companies that are not rated still borrow money from banks and other financial institutions. By looking at the most recent borrowings made by a company, we can get an idea of what banks are charging their companies and the default spread, and use this information to come up with a cost of debt. Estimate a synthetic rating and default spread. An alternative is to play the role of a rating agency and assign a rating to a company based on its financial ratios. This rating is called a synthetic rating. To make this opinion, we start with rated firms and study the financial traits shared by companies in each rating class. Let's look at a very simple example using the operating income to interest expense ratio, which is the interest coverage ratio. And we compute it for each rated firm. In worksheet 2.24, we list the range of interest coverage ratios for manufacturing firms in each S&P ratings class arranged by market capitalization into large, greater than 5 billion, and small, less than 5 billion. We also show the standard default spreads for bonds in each rating class in July of 2021. So here we have our worksheet. We have an interest coverage ratio, small market cap less than 5 billion, here greater than 5 billion, the rating and the typical default. If you're a small firm, you can see how much you're penalized with a market cap less than 5 billion. If your interest coverage ratio is greater than 12.5, you're a AAA company. You can work it down. Obviously, here's our average. The average interest coverage ratio for a small firm, 4 to 4.5. You're going to have a triple B rating. Typical default spread is going to be 1.06%. If you're a well-rated company and you're in the A class, you can see the relative benefit. And then as things start to deteriorate, the costs are irresponsible. So there is a typical default spread. You're just going to add this to current treasury. That's step one. We'll find reasons to penalize small companies for one reason or another. We're going to have country default risk. We're going to have just a whole bunch of other things that really tack on to the overall cost of either debt. Now let's look at a private firm with 10 million in earnings before interest and taxes and 3 million in interest expenses. It has an interest coverage ratio of 3.33. So we're going to go right in this arena right here. For a small company, 3.33, going to be this 3 to 3.5. So I think they're going to be double B. Based on this interest coverage ratio, we would assign a synthetic rating of double B for the company and attach a default spread of, well, here it's 1.99 because I'm always updating stuff. You'd add the 1.99% to the risk-free rate to come up with a pre-tax cost of debt. Pre-tax. A large market cap firm with the same interest coverage ratio would be assigned a rating of, and you'd go all the way up here, large, and they have a 333, so they're going to be right here of 0.84. So you can see you go from 0.84 to 1.99 just because you're a small company. Ouch. So they double it. Is that fair? Well, the market sets the rules. If you don't like it, use equity. By basing the synthetic rating on the interest coverage ratio alone, we run two risks. One is that using the previous year's operating income as the basis for the rating may generate too low or too high a rating for a company that had an unusually good or bad earnings year. We can answer that by using the average operating income over a period, say 5 years, to compute the coverage ratio. The other is that we risk overlooking the data that is available in the other financial ratios, along with qualitative data used by rating agencies. The counter to that is to widen the analysis to include other ratios. The initial step would be to compute a score based on multiple ratios. For example, the Altman Z-score, which is used as a proxy for default risk, is a collection of 5 financial ratios which are weighted to generate a Z-score. The ratios and their relative weights are typically based on the historic track record of company default. The second step is to link the level of the score to a bond rating, such as we did in worksheet 2.24, with interest coverage ratios. In making this choice, though, recognize that complexity comes at a cost. While interest coverage ratio only ratings may not always produce as good an estimate of synthetic ratings as credit or Z-scores do, the difference in rating resulting from the scores are far harder to explain. The reason for our preferences is that the interest coverage ratios ratings, albeit flawed, are more pronounced. Calculating the weights of debt and equity components. Once we have costs for each of the different financing pieces, all we need are weights on each piece to figure out the cost of capital. In this section, we consider the choice for weighting, the reason for using market value weights, and if the weights can adjust over time. Choices for weighting. In determining weights for debt, equity, and preferred stock, we have two options. We can take the accounting estimates of the values of each funding source from the balance sheet and calculate book value of weights. Or we can use or estimate market values for each piece and figure out weights based on relative market value. As a general rule, the weights used in the cost of capital calculations should be based on market values. This is because the cost of capital is a forward-looking measure and captures the cost of raising new money to finance projects. When new debt and equity has to be raised in the market at prevailing prices, the market value weights is the right choice. There are few analysts who keep on using book value weights and defend them using 4 arguments, none which are persuasive. Book value is more reliable than market value because it is not as volatile. Yes, it is true that book value does not change as much as market value. This is more an indication of weakness than strength because the true value of the firm changes over time as new information comes out about the firm and the overall economy. We would make a case that market value, with its volatility, is a much better indication of true value than its book value. When estimating debt ratios, it is better to use book value as opposed to market value. The book value of equity in most companies in developed markets is generally well below market value, while the book value of debt is typically close to the market value of debt. Since the cost of equity is much higher than the cost of debt, the cost of capital calculated using book value ratios will be lower than those calculated using market value ratios, making them less conservative estimates, not more so. Since accounting returns are established based on book value, consistency requires the use of book value in computing the cost of capital. While it may seem consistent to use book values for accounting return and cost of capital calculations, it just does not make economic sense. Since the funds used for these projects can be used to earn market rates elsewhere, the costs ought to be calculated using market value weights and market rates. Estimating market values. In a world where all funding was raised in financial markets and all securities were continuously traded, the market values of debt and equity should be easy to find. In practice, however, there are a number of stocks and bonds where limited market value information is available, even for large publicly traded firms, and none of the financing components are traded in private firms. The market value of equity, you can determine the market value of equity by multiplying the number of outstanding shares by the current stock price. Using stock prices over time or any other normalized version of the price is not a good practice because it measures the cost of raising funds today. So the market value of debt ratio, 15% times 0.9 plus 5% times 0.1 equals 14%. Market value of debt. Book value of debt ratios, 15 times 0.7 plus 5% times 0.3 equals 12%. Multiple shares of classes, multiple classes of shares. If there is more than one class of shares outstanding, the market values of all these securities should be combined and looked at as equity. Even if some of these classes of shares are not traded, market values have to be estimated for non-traded shares and added to the combined equity value. Equity options, if there are other equity claims in the company, warrants and conversion options and other securities, these should be valued and added on to the value of the equity in the company. In the past, the use of options as management compensation created a host of problems because the value of these options had to be estimated. How do we estimate the value of equity for private businesses? We have 2 options. One is to estimate the market value of equity by looking at the multiples of revenues and net income of publicly traded companies. The other is to ignore the estimation process and use the market debt ratio of publicly traded firms as the debt ratio for private firms in the same business. This is the assumption we made for capital construction. We use the industry average debt to equity ratio for the engineering construction businesses as the debt to equity ratio for capital construction. The market value of debt. The market value of debt is typically much more difficult to figure out directly because very few firms have all their debt in the form of bonds. A number of companies use non-traded debt like bank loans, which are in book value terms, not market value terms. To get around the problem, many analysts make the simplifying assumption that the book value of debt is equal to its market value. Although this is not a bad assumption for mature companies in developed markets, it can be a mistake when interest rates and default spreads are unstable. The simplest method for converting book value debt to market value debt is to value all of the debt recorded in the books as a coupon bond, with the coupon being equal to the interest paid on the total amount of debt and the maturity being equal to the weighted average maturity of the debt at face value. The coupon bond is then valued at the company's current cost of debt. Thus, the market value of $1 billion in debt with interest expenses of $60 million and maturity of 6 years, when the current cost of debt is 7.5%, can be estimated as follows. 60 times 1 minus 1 divided by 1.076 to the 6. This looks like the annuity formula. Plus 1,000 divided by 1.06. And all we're doing is discounting the cash flows and the $1,000 in debt. So we get a cost of $928.82. This is an approximation. A more accurate compensation would require valuing each debt issue separately by using this process. Can financing weights change over time? Using the current market values to calculate weights will generate a cost of capital for the current year. But can these weights attached to debt and equity and the resulting cost of capital change from year to year? Well, absolutely. And especially in the following scenario. Young firms, since they lack the cash flow or earnings to support debt, young companies are frequently entirely equity funded. Growing profits and cash flows typically permit higher borrowing as they get bigger. When examining businesses at the beginning of their life cycle, we should account for the likelihood that the company's debt ratio will eventually rise to the industry average. Target debt ratios in changing financing mix. Mature firms sometimes decide to change their financing strategies, pushing towards target debt ratios that are much higher or lower than current levels. We should take into account the anticipated changes as the company moves from its current to the target debt ratio when looking at these companies. Overall, the cost of capital should be computed as an annual figure with different inputs used every year. Not only will the relative weights of debt and equity change over time, but so will the cost of debt and beta estimates. The fact that the beta can be estimated annually as a function of the anticipated debt to equity ratio is, in fact, one benefit of using bottom-up betas. Example, market value and book value debt ratios, Granite Construction and Capital Construction. Granite Construction has a number of debt issues on its books with varying coupon rates and maturities. Worksheet 2.8 summarizes Granite Construction's outstanding debt broken down by when the debt comes due. We treat the debt due in 2021 as due in 1 year. The debt due in 2022 is due in 2 years, and so on. The debt due after 2033 is given a maturity of 10 years based upon a perusal of the actual due dates on the long-term debt. So we have due in 2023, maturity 2 years, amount due, percentage due, weights, etc. Weighted average 331. To convert the book value of debt to market value, we use the current pre-tax cost of debt for Granite Construction of 5.58% as the discount rate. The face value of debt, $399 in July 2021, as the book value of debt, and the current year's interest expense of $24 million as the coupon payment. So we take 24 times, we use this up above. So we have a market value of debt of 406. Keep in mind, looks like I used 399. Looks like it's 331. You can adjust this if you want. To this amount, we add the present value of Granite Construction's operating lease commitments of $42 million. Adding the $42 million debt value of operating leases to the market value of debt of $357 million yields a total market value or debt of $399 million at Granite Construction. For Granite Construction, the market value debt ratio of 22.74% is lower than the book value debt ratio of 42.41 for the industry. estimating and using the cost of capital. With the estimates of the cost of the individual pieces, debt, equity, and preferred stock, if any, and the market value weights of each of the pieces, the cost of capital can be calculated. If E, D, and P of S are the market values of equity, debt, and preferred stock in order, the cost of equity can be shown as follows. Cost of capital is a gauge of the combined cost of raising money that a company faces. It will usually be less than the cost of equity, which is the cost of just equity funding. It is a point of bewilderment to many analysts that both the cost of equity and the cost of capital are used as hurdle rates in investment analysis. The best way to disentangle this bewilderment is to understand what it is right to use one or the other. If we want to look at only the equity investors in a business or a project and figure out the returns earned just by these investors on their investment, the cost of equity is the correct hurdle rate to use. In measuring the returns to equity investors, then we have to look at only the income or cash flows left over after all other claim holder needs, interest payments on debt and preferred dividends, for instance, have been met. If the returns that we are measuring are composite returns to all claim holders based on earnings before payments to debt and preferred stockholders, we should be looking at the cost of capital. Although these principles are abstract, we will consider them later when we look at examples of projects. Estimating the cost of capital. Completing the analysis in this section, we first determine the cost of capital for each of Granite's construction divisions. In making these estimates, we use the cost of equity that we figured out at each division level in example 2.13, and Granite Construction's cost of debt from example 4.14. We also assume that all of the divisions are funded with the same mix of debt and equity as the parent company. Worksheet 2.31 provides estimates of the cost of capital. We have the cost of equity. That's going to be pulled from another area. After-tax cost of debt. Here are your ratios, equity to debt to equity. Then we have debt to debt plus equity. Here's our cost of capital. Here's the calculation. All we're doing is taking this cost of equity times their debt ratio. Then we're going to take this ratio times the after-tax cost of debt minus taxes, and we're going to come up with this particular number. On average, Granite Construction's cost of capital is 6.2. Divisionally, we have specialty at 6.19, 6.76, 639, and 552. The cost of capital for Granite Construction's operating asset is 6.12%, but the cost of capital vary across divisions with a low of 5.52% for the water division, to a high of 6.7% for construction and engineering. Brad Williams, Frugal Finance. Thanks for watching.